Hello, good morning, tēnā tātou katoa, nau mai, haere mai. Welcome to Day 3 of the Financial Services Council 2020 Conference, Generations. I will be your MC and friendly face throughout today's program. I'm Yvonne Davey, Manager, Super and Savings, Craig's Investment Partners. And having been MC for last year's FSC conference, I'm delighted to once again be part of this superb event in its new digital format. I hope you have grabbed your cup of coffee, tea, chai latte, or whatever is your regular morning beverage, and are ready to settle in for your session of choice. This conference has always been made by the sector, for the sector, with a big focus on providing gripping content to bring you the latest news, views and commentary from a broad range of speakers. Over the past 2 days, our breakfast sessions have targeted particular communities within the industry, including trustees and supervisors, workplace savings and Leduca. Today, the 3 sessions cover slightly broader topic areas with a medley of insurance, generations and fintech sessions. If you have any questions whatsoever about the event, please get in touch by emailing us at events@fsc.org.nz. Enjoy the show and I look forward to seeing you later.
Good morning and welcome to the Disability Income Sustainability session. We're disappointed that we can't be with you in person today, but being in a webinar virtual sort of format means that we can pretend that instead of the grey day outside, we've got this beautiful sunny day that I have on my screen behind me. So I hope that you're all able to enjoy the session and enjoy your coffee in the comfort of either your own home or your office as you dial in, and it probably gives opportunities to a wider audience to be able to dial in from outside of Auckland and to be able to watch the sessions later. So welcome everyone. Over the last decade, we've seen some changes in the New Zealand industry in terms of product offerings for income protection, the increased use of agreed value benefits, and the removal of ACC offsets for some products and an enrichment of product features. At the same time, we've seen escalating claims costs that end up being passed on to customers through price increases. The question that then must be asked is what can be done to ensure that there's a balance between covering customers' needs, including affordability, and some degree of certainty over future premiums. So we've got a great panel here today that can help ask or answer some of those tough questions. As discussed in Tuesday's breakfast session, the Australian industry has experienced significant losses in retail income protection over recent years, and fearing that insurers will exit the market altogether, the prudential regulator APRA has stepped in with requirements for the industry to address issues that they see as key risks. So things like agreed value sales, income replacement ratios, a requirement for policy review at least every 5 years, so rewriting for financial and occupation, underwriting, and managing risks associated with long benefit periods. Now there are differences between the Australian and New Zealand markets, and particularly Australian insurance needs tend to be met through superannuation plan benefits. So Australia does tend to cover a different sort of market with higher socioeconomic groups, whereas we do cover a broader set of customers in New Zealand. But we're not immune to some of the underlying causes of problems in Australia. We still have those same issues of chasing rating house points, and we still end up with some unsustainable product features. When we look further afield than Australia, some markets that have more stable experience in income protection are not necessarily meeting customers' needs. For example, US insurers have more restrictions around pre-existing conditions and mental health claims. And then New Zealand has its own unique challenges. So ACC impacts on both claims management and also just customers' awareness of the need for income protection. How many people out there think the government's going to take care of it for me because I have ACC? I know that the experts on the panel are all passionate about finding a solution to balance these complex needs. Katrina Church, a financial advisor and head of client engagement at Insurance People and Mortgage People, is passionate about advancing clients' well-being through supportive insurance advice. Kris Ballantyne is the Chief Marketing Officer of Partners Life and is in charge of the product and marketing areas. He has a decade of experience in product development and design. Peter Doherty is the Chief Customer Officer at Fidelity Life, where he's driven by a desire to move past a view of life insurance as a combination of products and policies to one that starts with the customer. And Elikhis is the Chief Officer of Product and Vitality at AIA. He's responsible for product design, pricing, analytics, and the Vitality Healthy Living Rewards program. Len has been working in the New Zealand insurance market for the last 7 years, and prior to that worked in Australia as a consulting actuary. So similar to me, that actuarial experience, and I know we've both been closely following, as have all the others, what's happening in Australia and how much of that we're seeing in the New Zealand market. Now, I'd welcome any questions as we go through. There's a lot that we want to discuss as a panel, and I know when we got together to talk about this, everyone's very passionate about it, but we'd also like to make sure that we cover off any questions that you might have. So please do pop those into the Q&A as we go. So Katrina, can we start with you? Because obviously everything starts with the customer, and at the centre is meeting the customer's needs. What do the customers expect when they buy income protection? And how does income protection fit into meeting a customer's broader insurance needs?
So the reality is, and good morning everyone, it's actually lovely to be here, and it's really cool to actually see product advice and everyone coming together to sort of discuss this from a collaborative point of view. But when you're looking at the client's perception, when they purchase income protection, it's really clear. They have an expectation that it's going to respond when they need it, regardless of what their client obligations are around it. We saw this in the first lockdown. There is still a lot of confusion around what income protection does. People were ringing constantly or emailing around how is this going to respond around redundancy or loss of revenue in our businesses, and we still have a perception issue there. And I think that's something that we have yet to overcome, and is one of the issues why a lot of people actually still don't purchase the product. In regards to how income protection actually fits inside an insurance plan or on the list of insurance covers, the simple fact is if you still rely on your income to come in to meet your financial obligations, to pay the bills, to pay the mortgage, to put food on the table, then it is the most important policy to actually insure yourself for. However, it's not often at the top of the list by any stretch for businesses and families. If you're sitting with a cancer survivor or someone who's had a shoulder surgery that has been declined by ACC because it's degenerative, or someone's got a long-term illness like Parkinson's or MS, they will see income protection as being gold. It gives them the chance to heal. It gives them a chance to reset. It gives them a chance to actually protect their assets. So it's so important to the New Zealand landscape that we do everything we can to keep this product sustainable. However, if you give a client a menu of insurance policies to look at, and that's what I do, I sit and I unpick it all and I give them a list and I give them a whole lot of pricing, they won't always put this one at the top of the list. A client can visualize the need to have car insurance because they know what it's like to have a car crash. They can visualize the importance of potentially insuring their mortgage for life insurance because they don't want to leave their husband or their wife left with a mortgage. But they don't often visualize what it's like to have the landscape changed and their income removed. And I think the greatest opportunity that COVID has brought us as an industry is that we now actually have really seen what it can be like when your income stopped. If you look at the work that actually the FSC, and congratulate them on this, and I wish we actually use this data more and more and more, the Mind the Gap work that was done in 2016, said that there was of the employed people between 18 and 64, 46% of them, that's 46% of them, could not cope for more than a month without their income coming in. COVID has done nothing but actually make that tougher. New Zealand's resilience, Kiwis' resilience is there, but it's been dented. When covers are put in place, they are often not reviewed and checked and kept current, waiting periods, payment periods, and things like that. So, the need for income protection has never changed. It's still there. And we as an industry have certainly got challenges around getting that perception of need available for Kiwis.
Thank you, Katrina. Some scary stats there in terms of people's ability to survive an interruption to their income, and clearly a strong need to make sure that it's available and affordable to the general population. I'm sure that anyone who doesn't have income protection insurance and suffers an illness or injury would be focused on a return to good health and productive employment. But Len, perhaps you could comment, are there some design flaws in our existing products that actually impede this return to work? And what do you think needs to change so that we can make sure those customers are financially supported without slowing down their recovery?
Good morning, everyone. Look, I don't think there are any impediments to helping customers recover. Unlike the situation in Australia, New Zealand insurers are able to and do pay for the costs of rehabilitation and recovery support. And generally, we have provisions within our policy wordings that require customers to comply with reasonable treatments recommended by the attending doctor. But having said that, there are product design features that reduce some of the financial incentives of returning to work. And an obvious example is minimum indexation rates. So some policies and business practices, including ours at AIA until a couple of years ago, allowed the insured benefit, the income benefit, to increase at a rate of about 5% per annum. And in most cases, incomes are rising at a lower rate, especially at the moment. And so over time, the insured benefit will creep up and will approach the person's income. So if I'm earning $100,000 and my income protection benefit has now increased to about $100,000, I'll be less financially motivated to return to work than if my income remained at about the $65,000 mark, which is roughly where it's set at the point of policy commencement. Another important design feature is the definition of disability, and often this is overlooked. So currently we assess claims against the person's ability to perform their own occupation. So if I'm a builder, I'm assessed against my ability to work as a builder. And this is a reasonable approach in the medium term because it gives people an opportunity to recover or to adjust to their new level of ability. But the question is, does it make sense to apply this approach into the longer term, or should we expect and encourage people to return to suitable work if they're able to under the new standards of ability? So extending my earlier example, if I'm a builder and I'm no longer able to work as a builder, but I am able to work as a site supervisor, or I'm able to retrain and work as a surveyor or a project manager, should I return to work? And that's fundamentally the question. Are we trying to get people back to work, or are we trying to get people back to the job that they were doing before they became disabled? The former is likely to be more sustainable and more aligned to the principles of return to work and recovery, but the latter is cleaner and easier for customers to understand.
Kris, Peter, did you have any comments to add in terms of what you see as issues around the product design that might discourage people financially from that return to work, or incentivize them to stay on claim?
I think, as Len has mentioned, the real challenge is the challenge is that it's the yin and the yang of the product. The thing that's great about it is the thing that makes it quite dangerous and challenging as an industry. And really, where the challenge lies is trying to make sure that it's focused on that return to work, because we know that productive work is good. Medical evidence suggests that it is good for our mental health to be in productive work. So actually helping people back to work is key. And I wonder if it was called back to work cover, would it actually have a different impact on the mindset of people who have to claim on it?
Yeah, good morning, everyone, as well. It's Kris here. Just to add to that, because I agree completely with both Len and Pete on that point, I think the nuance of talking about product features here is there isn't one thing you can point to say that's definitively broken, that's causing issues. And it's really easy to reach for that silver bullet. And excuse me, I've heard it a lot around the market, even within our own business, potentially at some times. Well, why don't you just remove this feature? Why don't you just tweak this level? Why don't you just change that? And it's not that binary. So, as Len said, there's an element of intervention in claims. There's an element of financial motivation, which could be caused by even underwriting replacement ratios up front and a combination of agreed value and indemnity style calculations that aren't always as pure as they have been. Even down to the mechanical details, like, allowing longer waiting periods where there isn't some other cover in the interim, so your notification time gets longer. And, if it sounds like I'm listing everything in income protection, that's because almost every element of income protection has something that could be tweaked or changed or adjusted to allow for sustainability, both of a product line point of view, but also sustainability in the sense that it makes sense for what the customers need at a core level and therefore can be priced at a level appropriate to them. I think therefore it's a very complex process, and it's why it's taken so long in Australia to come to any sort of recommendations or action.
Thank you. And I think, Kris, you hit the nail on the head there, that it's a complex bundle of issues which have been raised by Len and Peter and yourself, that there isn't just a simple, we just need to tweak one thing and we can fix it. Peter, I know, coming from another industry, you were surprised at some of the differences in the way that the life insurance market works. So things like not reassessing for changes in customers' circumstances. How do we balance the rights of the individual customer in reassessing the amount of risk associated with them, with the fact that will ultimately be cross-subsidized by other customers if we're not passing it on to the individual?
Yeah, I mean, coming into the industry from outside, I've asked the question why a lot over the last year, and I've learned a lot along the way. I suppose if I think about income protection and some specific examples of it, if I translate it to insurance that we all understand, as Kat mentioned, in terms of car insurance, if you drive a Ford Focus and that's your car, and all of a sudden you decide you're going to drive a Ford Mustang, the expectation in the customer's mindset is that they would most likely need to change their insurance, or at least let their insurer know. And in reviewing some of the information coming from Australia, I was kind of questioning, when people change roles, when people change jobs, when their circumstances change, are they reassessed? And I was genuinely surprised that the answer was no, because that to me is a change of risk profile. But what I'm learning is it's not as simple as that. And income protection is probably one of the more complex pieces of insurance, never mind just in life insurance, because it depends on whether the customers are waged or salaried, whether they're self-employed, how many hours they work, what tolerance they have for hours of work. All of those things all change the risk profile in as much as the occupational class itself. The other thing I've learned is that the industry really doesn't want to try and disadvantage any individual customer in any way. And so we do what we can to try and make sure that everybody receives an equitable outcome. But there are things that we can do to try and make sure we're treating everybody fairly, and that we're trying to drive some degree of sustainability back into the product. As we touched on before, the difference between own occupation and any occupation is a clear one, but it also comes back to the actual disability that somebody has suffered, there can be a better return to work for people who have certain conditions, depending on the nature of their work. Some neurological conditions, for example, may allow people to reduce their hours, but to still do effective work. Others might not, and so everything needs to be treated very much on a case-by-case basis. There's also then the challenge of reinsurance. So we're all backed by reinsurance to some degree or another, and many of those reinsurance policies all have similar terms and conditions in them that we offer to our customers. There may be circumstances where symptoms of a customer's illness or affliction may be similar to things that are defined within either our policy or the reinsurance policy, and quite often we find ourselves having to go into bat for our customers and on behalf of our customers with the reinsurer to make sure that our customers' interests are protected further up the chain. So there's a lot that we can do to try and balance that risk, but ultimately what I have realized is it's complicated.
Thanks, Peter. Kris, Partners Life made some changes to its income protection offerings earlier this year that echoed some of APRA's recommendations around agreed value and replacement ratios. How challenging is it to be the first mover in making changes like this that try and address sustainability?
It's a really interesting question, Shami, because in a sense, I mean, I know you mentioned it mirrored some of APRA's recommendations. That wasn't necessarily what we were going for. And in a sense, we are the first movers, but we don't necessarily feel like the first movers completely. And let me just try and articulate that, because in my mind, product sustainability has two functions. One is the sustainability of your pricing methodology or your ability to continue the product as a line that you can justify from an actuarial point of view and you can quantify the risk on. And the second line is sustainability in the sense that it's something that clients can access, understand, afford, and want to continue with. We really, as a result of claims experience, which is, both incidence and recurrence rates and length, felt we had to address at least the first component of that so that we weren't, causing a very negative feedback scenario where bad risk affected your overall book, which therefore increased prices, which increased selection rate, which then increased the bad book. So to an extent, it's extremely difficult. And I believe the words that APRA used for the Australian market was an insurmountable barrier. But, the changes we've made to date were to address a very specific issue that was showing up in our data around self-employed lives. And that's a challenge in New Zealand where there's a huge quantity of self-employed lives and small business owners. That probably is not going to be the end of the changes that are needed to make. So that's why I say I don't necessarily feel like we are the first full movers. And whether our competitors, including the gentleman in this call, take the same approach or a different approach is, obviously going to be based on what data they're seeing and where they think the inflection points are in their processes or their product. And so, yep, it's a big challenge. It's one that I feel like someone had to make, but it's probably not going to end there because, as we've talked about already, and as we could talk about for hours today, there's so many mechanical issues that just cause pain at various areas. I feel like the first mover will truly be the one that redesigns the income protection product for the New Zealand market rather than really where we started from 10 to 20 years ago with a product that was roughly what was being seen overseas.
Sorry, Len, Peter, did you want to respond in terms of that, the first mover and whether your organisations are seeing that barrier in terms of making changes and how it reflects on the competitive landscape?
Yeah, look, I agree with Kris. Just a minor point to add. I think partially there's the first mover being the company, and then I think there's also just the question of whether the market will embrace that design change. And in Australia, what was found is there were companies that in the interim had developed products that were more sustainable But for various reasons, one of them being product rating houses and the interaction of the product rating together with the regulatory framework and pressures on advisors to be seen to act in the customer's interests, created confusion that if a customer was recommended a product that wasn't highly rated, that introduced advice risk to the advisor. So I think there was some complexity there in terms of either, ambiguity potentially around the interaction of the advice process to get together with a product recommendation. And I think that the second point to it is kind of more actuarial, which is that the products generally were underpriced. And so if you develop a sustainable product that's set at the right price actuarially, and you then compare that product with fewer features, with more controls, some of the controls that Pete and Kris and I talked about in the past, and you compare that price to the price that's in market of the fully spec products, there wasn't enough of a price differential to drive volume to that product. And both of those, I think, were structural elements that led APRA and the rest of the industry to, come together and take a more top-down approach.
Katrina, we've heard that one of the challenges around income protection is for self-employed versus, obviously with employees, you have some very straightforward definitions of what someone's income is and things like that. Can you maybe address the issue from an advisor perspective, and how do you work with your clients in terms of self-employed people and defining their income protection needs?
Well, I thank you. I do want to just echo, I thought it was a very brave thing for partners to do in regards to how they made the changes to their income protection product. And one of the things that wasn't really picked up on by the market so much is that they really wanted to see the self-employed market getting on claim quicker. Okay, so when we are traditionally looking at 4-week, 8-week, 13-week stand downs, there is a lot of self-employed people that will be sitting on 13-week stand downs, when the reality is they really need to be on more 4-week spaces because they need the money earlier and quicker. Whether it's getting the money in quicker or whether it's actually getting support to get well quicker. And I think that was one of the inferences I certainly got from Naomi when she presented to the market as to why they'd made that particular change. I think the advisor force needs to take a little bit of responsibility about whether we've actually served the self-employed market as well as we could, and whether we need to challenge ourselves a little bit further in that in the future. There is no point just ensuring someone's taxable income when they're self-employed. They live their lives through their businesses, their phones, their internet, they're part of their mortgage, their vehicles. They're all put through the business, but are we actually ensuring that? Are we actually making sure that those things are taken care of if someone can't work? Invariably, you'll find a self-employed person will come to you at the end of their tether rather than earlier, because that's just the nature of the beast. And so I think what Partners was trying to do was to encourage people to really set out when do they need the money. And I think it's earlier rather than later. Secondly, I think that we need to look at the product piece. We have done a lot of work in the advisor space around Cover Plus Extra, and there is a bunch of people that have definitely gone ahead and reduced people's ability to have weekly compensation and use those premiums to purchase a product which possibly you could certainly argue is better, being a sickness and accident cover. But have they really got the money coming in quick enough? Have they made sure that there was money coming into the business as well as the individuals? So I think I will take from what Partners have done over the last little while and take stock and say, what do we need to learn here? If that market is being hit, then we need to serve it differently. And I ask all advisors that might be listening to this, or product designers, to really, or BDMs, let's start having that conversation, because New Zealand is full of self-employed people, and they have just increased possibly with COVID. If one of the areas of jobs that have disappeared is a lot of female occupations and so forth, a number of those people are going into self-employment, and how do we now best serve them with this type of product?
Thanks, Katrina. And I think that's a really good challenge to lay down to both the advisors and the insurers to make sure that we have a sustainable product that can serve our market and the way that our economy works, because we do have a large number of small and self-employed, small businesses and self-employed people. So we need to make sure that our products are sustainable and available for them. Len, while some of the Australian learnings might not be applicable to the New Zealand market, I know you have been following what's going on in the Australian Institute of Actuaries working group. Have you seen any really good ideas coming out of that you think might help us in the New Zealand market?
Yeah, look, there have been a few, and some of them are product aspects, some are pricing and process aspects. So I might just touch on all of those. I think, as we've talked about, this is a multifaceted problem. So there isn't a silver bullet solution to point to, and it's about the interaction of some of these factors, as well as the interaction of the customer expectation. So I think, just starting from a product perspective, I think having an own occupation definition for a certain period of time, whether that's 2 to 3 years, and then transitioning to what's referred to in Australia as a suited occupation. So that is an occupation based on education, training, and experience beyond that point of time, will mean that there's an expectation set in the mind of the customer that there's there's an expectation to retrain or to look for alternative employment paths, and that can help get people back to work and reduce some of the long-term claims costs. That's also a feature that we see in some of the more sustainable markets that you talked about in the introduction, Shami. I think the other thing they're doing in Australia is simplifying the product by stripping out a lot of built-in benefits that we know add costs. So, built-in injury covers, illness covers, TPD benefits, all of those collectively make quite a significant contribution to the overall claims costs, and a lot of those are being removed. I think from a process perspective, and Pete touched on some of this as well, I think there's a few things that we can do that are logical. The regular occupational underwriting, I think, just makes good sense. So, writing to customers every 2 or 3 years and asking them to inform us if their occupation has changed. As we do with car insurance, we want to be able to price on the risk that the customer presents. And so if their occupation has changed, it's completely logical. And I think most customers and advisors would agree that it's logical for them to inform the insurer, and we can then adjust our pricing to reflect that risk. I think, furthermore, early notification of claims is something that we need to consider. A lot of people think that, and we see this in our data, that they need to wait before the end of the waiting period to notify a claim, and that just creates issues in some cases in terms of being able to intervene with a client and provide some support to get them into that recovery mode. And from a pricing perspective, I think we need more granularity. At the moment, we've got largely four or five pricing series that we use for our occupations, and in Australia it's upwards of 8 to 12. So there's far more granularity. So as an example, we would deem an occupation class 1 would be say an accountant or a lawyer, and would also be a dentist and an orthopedic surgeon. And for the latter two categories, there's far more physical intensity to the work that they do, and obviously the risk profile is quite different. So I think there's a lot of stuff there. But equally, as we just talked about, that our market is subject to the same competitiveness pressures. So we do have to be kind of realistic about the market embracing some of these changes. But nevertheless, I think it's good to give people choice and options, and yeah.
Katrina, a question that's come through the Q&A, which I think you might be able to answer for us. Is there an age at which people start finding premiums unaffordable? And how do you think we might be able to change that profile? Which is probably more for the insurers. How can we change the profile? So, Katrina, any particular age that unaffordability becomes an issue?
When you're certainly getting in past the 55-year-old age, it is more difficult to sustain those premiums. At the same time, any age can be a challenge if there is not a lot of income to be able to pay for this product. At that stage, I think it's also a person's profile possibly has changed from when they originally purchased the product. Their asset base may have increased. Their capacity to have cash in the bank or having more resources available to them, certainly if they own property, etc., means that their risk profile allows them to have longer wait periods or less differences around payment periods. So I think that we need to engage with clients very much so on a regular basis to see how the product is serving them. And that's a question I often ask when I'm actually reviewing a client. How is this serving you? You know, have we set the level at the right amount? Someone, when they're in their early 30s and 40s with big mortgages and young families, need to insure all they can, because often that's not their highest earning capacity. When you're in your mid 50s, you're getting your children are often off your hands, you've got more assets, you also are getting ready for retirement. So maybe you don't need to insure as much, but there still is a need to have a certain amount of cover. I'd be still loath to actually remove the product from a portfolio. It just needs to be massaged to be able to keep within the price point. One thing I would say is that we are seeing more people hitting the 60s still needing the product because they still have a mortgage. And so when it finishes at 65, that can be a bit of a shock, because a number of them are now still continuing working through to age 70. So I think that's something we need to think about going forward as well.
The
Sorry,
age
Katrina.
70 is interesting, Katrina. I know the Australian benchmark product that they put together for disability income had a really low age. I think it was about 60, so even well before retirement age. So it's certainly something where they're not necessarily reflecting the customer needs and something that we need to make sure is addressed in terms of making sure that the product is suitable for customers and covers their needs until they are able to pay off mortgages and things. I guess it's an issue even if someone doesn't suffer from an illness or injury as they get older. Are they going to pay that off in time for retirement when we've got escalating house prices? But it's not something that we're going to be able to address. No. As an insurance industry. One thing that we can address as an insurance industry, I guess, is the affordability. And Kris, you have some ideas in terms of how we can help with that from an insurance perspective?
Yeah, well, thanks, Shami. I actually just want to add something to what Katrina was just saying, which is that I guess my experience or the anecdotal feedback I've heard over years, and in a past life before being a product person, I was an advisor for a relatively brief period of time. That feedback we've had more or less across the industry is that income protection at any age is very expensive and relatively hard to recommend, not from a risk point of view. It's kind of one of the easiest risks to articulate in many senses because it's not tangential. It's your biggest asset, earning your future potential for earnings. But it is very much a large, if not the largest component of an overall premium breakdown in a recommendation. And so I don't necessarily think there is any inflection age at which it starts getting unaffordable. There's probably ages at which it starts getting almost crazy in its current state. But it's just as hard to recommend it to a 30-year-old as it is to a 55-year-old from a point of view of making that initial sale. And Len touched on it before, but the difference between what are historically more cut down products and the full products, in a current pricing structure and with the current, I guess, actuarial levers or the modularity of our modal pricing is not big enough to overcome that. And that's historically where some of the issue has been from an insurer's point of view. Is it'd be great if we could just go, yep, let's crank out a couple of these optional benefits. Let's, limit it to X benefit term, and that will be done with it because that's a big decrease. But it's really not. So there's gonna have to be a little bit more fundamental change here that, as we've talked about over the session, involves elements of product, but also elements of underwriting and elements of, long-term sustainability and potentially elements of more regular review in that contract. So, ideas the insurers can do today, we could start packaging parts of that product to pull out for clients. But again, my experience would tell me that, even if you pulled out almost all the ancillary benefits from a DI product as it exists today, that's not a huge component of the premium.
Yeah, mechanical changes will only go so far. There has to be a more systemic review of the product and addressing the needs.
Thank you. A question that's come up in our Q&A around rating houses. If we are making product changes to try and meet customer needs and sustainability, how can we get the rating houses on board, and what role should they play in redesigning income protection products? So open to anyone on the panel to answer that one.
I can take a step in. I mean, a big part of my role is promoting customer experience, but also introducing customer experience and CX design into how we build products, how we design services. A large part of that is moving away from the idea that we know best, and because we understand the industry and because we understand the products, that we can design the next set of things that need to be introduced into the market. We're working with customers, we're working with advisors, and probably the next step is to work with ratings houses and reinsurers to actually co-design that next series of products. Because if they're part of the design of the solution, then they should be able to recognize the benefits and acknowledge the need for change, and actually contribute to the end outcome, so that they actually have a part to play in it. I'm really passionate about getting a broad group involved in actually redesigning, rather than trying to figure it out for ourselves. Because no matter what industry you're in, I think what we've all realized is that we need to listen to our customers more. We need to listen to our partners more, because at the end of the day, they're seeing things play out firsthand.
I might just very briefly come in. I think what would be helpful partly is on the rating houses. I think in Australia, the way they propose to deal with that is through the use of the benchmark product to then enable the rating houses themselves to benchmark the various offers that are out there in the market. And so, at the moment, it's all, it's fundamentally based on the richness of the features. And so then with a sustainability index, it can surface some of that information to the advisor as objectively as possible to enable some of those other considerations to take place. And again, I think something that's topical in Australia, and something that the regulators here need to think about, is also then the interaction with the advice regulations. So, for example, in Australia, having some clarity around the best interest duties on advisors, that doesn't mean that the advisor has to recommend the best product. That the advisor is able to recommend a suitable product, taking into account a balance of both the product features as well as the pricing, I think is important to take away some of that risk aversion that drives the placement of the business.
Absolutely, Len. And if I can just add to that before we move on, even from a more micro level with the rating houses, there's something that could be done relatively quickly that would help with that issue, which is at the moment, all products of a particular category are rated together, regardless of where in the market they're supposed to sit or for what instances they're supposed to be used. So it's really common in DI and trauma and medical, effectively products with a large divergence between, the ones that are pitched at the premium end and the ones that are supposed to be more affordable, that it's not useful for an advisor or client if they're being put in front of a package that says, well, this one's 5 stars, but it's $200, whereas this one's $40. That's within your budget, but it's 1 star. What does that mean? That's not particularly helpful. And even if the rating methodology is correct, there is some element of, well, we need to get realistic about, the fact that our advised insurers are predominantly building product for the high end, but not always. And I don't think it should always be treated as such, because that only hurts clients and advisors when they're trying to do anything other than the most expensive thing when it comes to affordability conversations.
If I can just make a comment from an advisor point of view, when you're looking at rating houses, I think it's important to be abreast of it. I think it's important to know how a product sits amongst them all, but I don't believe that should be your final, by any stretch, reason for that product choice. What those rating houses don't take into consideration is how a claims experience is at each of the different insurers, and at different times it can be very different depending on resourcing. So, we talk about the heart of an insurance company. That is so important to put into play, and the people in this room, the people in this particular forum, all have the heart for what we're doing. So, you know, from my point of view, we've got to, from an advice point of view, not just look at rating houses, and every 3 months we have an internal committee that looks at the product offerings to the market, and then actually resets our choices as to who we recommend. And I think that's really important. Look at your claims experience, look at the way that that insurer actually supported your client through, and that will actually have as much relevance to product choice in my world.
Thanks, Katrina. And just touching on that claims experience, advisors are often a customer's first port of call. And how can you help customers during what's clearly a very stressful time when they do need to make a claim?
Thanks, Shami. It's a topic at my heart, very much so. So I am in a privileged position as an advisor for a client where we will often know more about what is going on for that client's health than what actually their own family does. And so it's it's an honour to be in that position. So we spend a lot of time developing a relationship with a family and a client or a business. So we understand the social dynamics within that family. We understand the resilience of the person often. We will understand the business flow if they're self-employed and how money actually works in their business. So we have a lot of intelligence that a claim form won't have. When a client is in a claim position, they're often extremely anxious. They are out of control. They don't have control of the situation. They're disempowered, and it's no fault of any insurance company. It's just the process, because it's nerve-wracking to think that suddenly I'm sick and I can't actually do my job that I was doing beforehand. So an advisor's role is very much around supporting that client through that process, and I think we're a very, very important part of how we get clients back to work. So once we get a client actually on claim, we've assimilated all the information, we've got it through to the insurance company, we've positioned them the best we can, we get them accepted. You almost see that relief in that client's face on now they can focus on getting well, healing, and getting on the road to recovery. And at that point, it's actually my role to sit down with them and say, how are we going to do this journey? What are we going to do? And start working with the insurance company to make that happen. If you are an advisor that's not actually doing that as part of your role, then I think you're doing a disservice to the industry and also to your client. I also think that there are sometimes difficult claims. You know, when things have been held up because we're waiting for ACC, or we're waiting for doctors, or we're waiting to get hold of psychologists and doing reports, and it's very hard for a client to understand that, because remember, they just want to go on claim, they just want to get paid. So from our perspective, we become a bit of a mediator. So we take a bit of heat off the claims manager as well, right? We are definitely in partnership with the client and the insurance company in that situation. We're not in a situation where we're actually battling with the insurance company. We're working with them to actually get this client through that. And I think that's a really important situation. There is often a perception that they won't get a claim paid that we have to sort of work through. The one thing I also think is really important, and it's something that we need to address more so, and we've actually heard a lot about it post-COVID, is mental well-being. I'm not talking about mental health. I think that has a connotation that someone has a problem. We need to, when we go through a claims experience, think about what the mental well-being is of that client, and how can we bring that to the forefront of that support around rehabilitation. Anyone that is not well, in pain, suffering from a cancer journey or whatever it might be, will have frustrations, will have stresses that they weren't experiencing before. And so how are we addressing that from a mental well-being, from a claims perspective? And I think that's a really important part for us to play.
Thank you, Katrina. And I certainly would value having my advisor helping to support me through a claims experience, because as you said, there's not just the recovery, there are so many other things going on in people's lives, and having someone to advocate for you and to help manage that journey and balance the needs between the customer and the insurer will be really important for customers during that piece. From an insurance perspective, what challenges do you see with managing income protection claims, and are there changes that we need to make to the processes to support better customer recoveries? Peter, perhaps if I could get you to respond first.
Yeah, I mean, in terms of handling the claims process, I mean, as Len mentioned earlier, one of the key differences between Australia and New Zealand is our ability to pay for rehabilitation, and that contribution towards rehabilitation is key. But more so, what we're seeing is the real value in using evidence-based and medical-based processes, getting early notification. The earlier we can start to help, the better. But also starting to use assessors specializing in particular vocations is also key. The reality is for many people, it's not necessarily about fixing them. It's about helping them get back to work. And we need to take a bit more of a broad approach in terms of how we do that. That can be looking at their condition and actually trying to figure out how we can help. Things like carpal tunnel syndrome, for example, that might not necessarily be urgent from a DHB treatment perspective. Private insurance can step in quickly to resolve that. But we also need to make sure that that's the only thing that's actually stopping or preventing the return from work. One of the things that we've done in the past is looking at things like cataract surgery to help people get back into the workplace quicker, and something that's not necessarily always prioritized either through the public service. I'm always impressed with the work that the claims team do, and as we've heard mentioned earlier on, there's sometimes a perspective or an idea that insurance companies try and avoid paying the claim, and actually the reality is our claims team really care about the customer, and they are trying their level best to help the customer with their claim and get back to work. What we do see is that comes through in our net promoter scores, where quite often we will see higher scores coming from customers who have actually been assisted off claim and helped back to work than similar customers who are actually on longer term continual claim. And I think we need to just keep reflecting on why that is, and work on doing more of it, helping people back to work through the right means and the right mechanisms in a medical and evidence-based process, I think is key.
Thanks, Peter. And Katrina, you touched on the mental well-being. Len, I know AIA's been doing a lot of work in this area, and also sort of putting in measures which you're trying to help customers avoid becoming ill in the first place. Did you want to comment on how insurers might move from being there to support customers who are already ill to being there to help customers avoid getting ill?
Yeah, so look, our brand promises healthier, longer, better lives, and we spend a lot of time talking about it, and it features quite prominently in a lot of our customer and advisor material. And we believe, and in fact we've seen data from other markets which confirms that insurers can develop programs and interventions to firstly improve customer health outcomes, and secondly to help make insurance more engaging in order to attract and retain healthier customers. So part is about selection and retention of healthier customers, but part is also about improving health outcomes for just ordinary people. And Vitality is a good example. It's a healthy living rewards program that's based on the principles of shared value through our partnership with Discovery in South Africa. And the program uses nudges and rewards to help customers understand and improve their health. And then the gains that we observe in claims and lapse experience are shared with customers by way of lower premiums and rewards. We launched the program in 2019, so it's still early days, but we are inspired by some of the stories and the possibilities we've seen, and just a few examples to help make it real. Very recently, we had a customer who started their policy with us a year ago with a higher BMI and some other risk factors, in terms of blood pressure and cholesterol and the like. And the policies were loaded by 100%. The customer engaged in the program and also made a conscious decision to improve her health. And so and after a year, she was able to make a lot of progress in that regard, and we were able to review and remove the loadings. And that's a really great example of supporting people who are already motivated to try and improve their outcomes. We had MoleMap, which is a skin check service, come and look at the skin of our staff for those people that wanted to participate in that. And quite a significant proportion of people, I think it was about 10 to 20%, needed some level of active monitoring. So there's, I think, a lot of opportunity to kind of couple insurance protection with support services to help people kind of improve their health outcomes. And I think increasingly people, customers are demanding that level of support as well.
Thanks, Len. I see we're running up against time. Time has flown so quickly, and there's a lot of material that I would love to cover with all of you. But one of the things, a lot of the things that we've talked about so far are issues that the industry was facing even before COVID-19. But it would be great to get insights from each of you in terms of how COVID-19 has impacted your customers and the way that your organizations are thinking about insurance and changes to products and things. So Katrina, perhaps if I could start with you first in terms of the impact that you're seeing on your customers.
So in final saying around that, the second lockdown has definitely been a lot harder in Auckland than what the first one was. In the first lockdown, we had the whole country coming together as one, and everyone was for a common cause. In the second lockdown, we've had fatigue and resilience issues, and Auckland was set aside to everybody else. And so I think that's caused a little bit of grumpiness and a lot more fatigue and tiredness in Auckland. That would be fair to say from clients. One of the things I think is important is there is a thing called COVID fatigue, and we need to address that. We've got people working from home though who have never done that before, and so there's some issues around actually making sure you have good breaks and stuff like that. It's harder, as much as the banking system has done an amazing job considering the turnaround times that they've all had to deal with. It isn't as easy to access funding from banks, so people aren't able to get hold of what they need when they need it. There's a thing called the responsible lending code, and it's going to get in the way in a lot of cases in that scenario. And so I think that is going to have an impact on people. We've had our first COVID claim. And Fidelity is actually dealing with this. I'm not going to talk about the claim too much out of respect for privacy issues, but I will say this: they didn't come to us to ask for help. They only came to us to ask for help around premium support because they weren't working as much because they'd had COVID. In their journey with COVID, they're now left with tiredness and fatigue and joint pains and so forth. And they have a product, they have an income protection product, and Fidelity has done a great job of actually helping start some rehabilitation issues without even going on to claim. We've got OT involved, occupational therapy. We've also got psychological support being organised for them. So Des Gorman's done a great job in that sense, and I've been it's been really awesome to watch. It's not one that I'm personally involved in. So I think we also need to be a bit careful about that with people, is that we don't want to actually segregate people who've actually had COVID. We need to actually wrap them up and help them through the next few months as we do. One thing I will say is I was on a seminar with ANZFIS just recently about mental health, and there is an increase of mental health issues on the way, and there is an increase of substance abuse. And if it would be fair to say, this country is not ready for that any more than what it is today. We don't have enough resources. So I think that's one of the things to take on board. We have a lot more people actually wanting to purchase cover. And again, big shout out to all three insurers here. You've kept the doors open through a really, really incredibly tough time to be able to purchase income protection, albeit slightly different variations of products. So well done you, because it was not an easy thing to get your reinsurers on board. So yeah, interesting times, and certainly a lot more to play out. I think it's not so much now that's the issue. I'm more interested in the next 6 months, how these businesses actually, these self-employed clients actually manage themselves through this. We're a resilient bunch though, us Kiwis down at the bottom of the world.
Thanks, Katrina. Kris, closing comments from you?
Yeah, I mean, obviously there's some issues to work through in terms of the actual insurance DI, not just DI medical as well, in terms of underwriting and acceptance terms, and there's been temporary things put in place. But for me, by and large, I'm just really proud of the industry we work in and how, as an industry, we've responded for customers, for our customers, for potential customers in what is an incredibly difficult and it's the classic uncertain time. But Katrina's right. there was some heavy pressure from reinsurers globally to shut the doors to an extent because we don't know what's going on. But we have been able to, as an industry, offer some great support for our customers and keep it going and keep protecting those Kiwis when they actually need it the most.
Yeah, look, I echo all that. I think all industry participants, from regulators, companies, advisors, the banks, I think just responded very well and with a lot of urgency to kind of recognize the situation and to recognize new ways of working and to adopt new ways of working. And I think at the moment we're probably in the survive and the revive phase, but I think the industry will come out stronger and more resilient and more progressive in the way in which we do business. So just congratulate everybody across the industry for the response and for continuing to respond to the developing situation.
Yeah, one of the slides from Susie Vide's presentation yesterday really was a sobering thought, where she said, the slide just said end of an era. And I think we do need to acknowledge that things have changed, and we need to help our customers through that adjustment. And I think everybody needs to bear in mind that one person's inconvenience might be another person's livelihood, just because somebody has had a holiday deferred or a breakaway delayed, that actually could have a more material impact on somebody on the other side. And I think that's going to be one of the lasting impacts of COVID, is the effect of that fundamental change on our lives.
Thank you all. That's been a really great session. And I think the most encouraging thing is to see that everyone really has the customer's best interests at heart. I know there's often a portrayal in the media of insurers as being the bad guy, but as we've seen from our panel here, and including the way that the advisors, Katrina, interact with the insurers, that everyone is really just trying to do their best by their customers, both the individual customers and the balance for all customers in terms of affordability and sustainability for the product. So thank you all for your participation today, and I hope that the audience have managed to get some valuable insight out of this session. Thank you.
Thank you. What a fabulous range of discussion we have had this morning. A special thanks to Bravura for their kind support of the FinTech session. It's so interesting to hear from the panel about how FinTechs view the next generation of investors and how the advances in technology is helping engage this group. And on the topic of generations, hearing the shared wisdom from the panel about their own leadership journeys gave some fantastic advice for the young leaders amongst us. And finally, the insurance session had wonderful insight from an all-star cast into income protection ideas, innovative ideas on helping Kiwis getting back to work. Before we launch into the main platform, where we hear from a mixture of politicians, journalists, and our keynote speaker, Jace Tapatu, please take this opportunity to have a 10-minute break, have a stretch, and enjoy some of the fresh spring air. See you in 10. Hei kon e rā.